A long strangle. This is where you buy an out-of-the-money call and simultaneously buy an out-of-the-money put. You use a trade like this when the market is range-bound and you expect it to break out of the range and make a large move, but you don't have a clear idea of which side to expect to break out. Similar to a straddle, but it is a less expensive strategy to implement by buying the out-of-the-monies instead of the at-the-monies. The profit potential is unlimited on either side of the trade in either direction. The break-even point at expiration is equal to the strike price plus or minus the net cost of the spread. Okay, here you've got a classic chart pennant formation, in which case you know the market's going to break out either up or down. Unfortunately, you don't know which way. There's an argument to be made on both sides. So you decide to strangle the market by buying a $7 call and a $6 put. Now, because of the implied volatility of these options, the premium's pretty expensive, but we'll go ahead with the trade. Now, how you get your break even on this trade, remember, only one side of this trade is going to make money, so you need to add the two premiums together. 15 cents for the put, 17 cents for the call gives you 27 cents. So in other words, you'll need the market to go beyond either strike price by 27 cents. That gives you a break even on the upside of 7.27. Now this doesn't include commission and fees. Or below the put by 27 cents, or 567. Okay, now the risk on this trade is if the market's in between either of these lines. Actually, if it's between the strike prices, you'll lose on both sides of the trade, if it's here. If it's above the $7 call but below this line here, your call intrinsic break even, you'll lose some or all of the investment. If it's below $6 but above your intrinsic break even here, you'll lose some or all or part of the investment. Or not investment, but cost of the option. Okay, but this is a very effective way of catching markets that are breaking out. 28 days later, let's see, first we get filled. Now, there is no margin on any long option position. Track and Trade Pro doesn't recognize that. It's not meant to do that. What we're trading out of here is what you call a bull flag or bull pennant. 28 days later, the market breaks out to the upside. Now, the gains on the $7 call are being offset by the losses on the $6 put. So thus we're not making money yet. We're losing $175. 28 days later. Now, remember, at any time you can lift the losing leg. 28 days later, the market's still going sideways, but had broken out above your $7 call. Will wind it back, and you're seeing a total gross profit of $28.75. Your $6 put is almost worthless. 28 days later, going into option expiration, the market falls back down below the $7 call. But on this type of trade, your risk is limited to the premium paid. Of course, would you have gotten out with the market right here? That's the question. It's a tough call. You'd be probably rooting it for it to go higher or something. But this is a long option strangle. Now, the risk is limited to the amount paid for the position. Maximum loss is realized if at expiration the market is trading between the strike price of the put and the call.